Hello, I'm Ivan Gruhl, Chief Investment Officer with Avantax. Today we'll provide a market update for January. We'll start with a recap of the year 2022 and all that transpired, followed by our outlook for the economy and the markets going forward. So let's get started. As we know, 2022 was a tough year for investors as economic uncertainty, geopolitical instability, and higher interest rates and inflation took their toll on both stocks and bonds. Following 3 consecutive years of double-digit positive performance, the S&P 500 index was lower last year by about 18%. While still firmly negative, international stocks outperformed domestic stocks, with the Morgan Stanley ACWI ex-US index falling about 15.5%. In bonds, the Bloomberg US Aggregate Bond Index fell more than 13%, recording its worst calendar year performance since the inception of the index in the early 1970s. The best performing sector this year was energy, which gained more than 60%, partially offsetting losses in other areas of the market. Excluding small gains from the utility sector, every other sector finished in negative territory for the year. As shown in this chart, inflation became the leading global concern in 2022, and the year was dominated by the Federal Reserve and the fight against inflation. Entering the year, markets remained optimistic that the post-COVID recovery would continue as supply chain issues started to resolve and the S&P 500 reached new all-time highs in early January. In February, Russia's invasion of Ukraine stoked the fire of inflation, sending energy and other commodity prices skyrocketing. By June, the S&P 500 had fallen nearly 25%, and inflation, as measured by CPI, had reached more than 9%. Inflation had quickly become the primary concern for consumers around the globe. In response, the Federal Reserve quickly shifted course and began aggressively hiking interest rates throughout the year. As the Federal Reserve's fight with inflation escalated, as this chart shows, the Fed implemented rate hikes in 7 consecutive meetings in 2022. Leaving the funds rate at a target range of 4.25% to 4.5% by year-end. These actions by the Federal Reserve throughout the course of the year are finally working. CPI inflation has been falling since June, benefiting from cooling supply chain pressures in things like warehousing and transport. Recent weakness in the US dollar, along with lower energy prices, have helped lower inflation as well. We believe better conditions lie ahead for investors. The Fed is now nearing the end of its tightening cycle, and much of the weakness in economic growth is currently reflected in valuations. This slide shows 10 of the major asset classes and their valuations according to Z-scores. That is, the relative richness or cheapness to history. The diamonds are the valuations at the end of 2021, and the circles represent current valuations, showing that most asset classes are considerably cheaper today, offering a good entry point for investors. After posting impressive real GDP growth of 5.7% in 2021, economic growth slowed significantly in 2022, with expectations for real growth for the year of less than 2%. Consumer spending has held up surprisingly well, but as consumers spend down their excess savings to keep up with inflation, this tailwind will likely dwindle and consumer spending should slow. As investors look forward in 2023, the big question will be whether the Fed can continue to slow down the economy while avoiding a prolonged recession. As we move into the new year, we urge you to make your financial plan a top priority and take a long-term view. After the recent global reset in valuations, we are optimistic about the investment opportunities and the higher potential returns in the future. So that's what we have for this month. Thank you for watching. Until next month, have a nice day.